The word basis, when it's used in the context of estate planning or estate taxes, simply means the cost of an item. So when we talk about the cost of an item, another way of saying it is, what is the cost basis of the item? So, for example, if we bought a house and the house cost $300,000, we would say that the basis of that house, the cost basis, is $300,000. Likewise, if we bought stock and it cost $1,000, $1,000 is our cost basis, or abbreviated basis. Now, the importance of what a basis is for a particular asset is that that is the number that will be used to determine whatever your gain or loss is when you sell the particular asset. So, for example, in the case of a house, if our basis or cost was $300,000 and we sold it for $400,000, our gain would be $100,000. Our sales price less our basis. So that's essentially what we mean by basis. Now, when we talked about stepped up basis, things are a little bit different. First of all, in the example I gave you, if we bought a house for $300,000 and we sold it for $4,000, we'd have a gain of $100,000. Well, under the estate tax laws and the income tax laws, there are certain situations where we can get a stepped up basis, which means in the case of a house, instead of the house having a cost basis of $300,000, it may get a stepped up basis to $400,000, which would mean when we sold the house, there would be no gain or loss. One of the ways that we get a stepped up basis is upon the death of an individual. Upon the death of an individual, generally, the basis of the house gets stepped up to whatever the market value is of the particular asset. I'm using a house as an example, but this would apply to anything else. So stepped up basis is something that we all like. It avoids income taxes upon the sale or disposition of the particular asset.